I'm Michael Smith.
I'm Chuck Osborne.
And welcome to the Iron Capital Podcast,
where we break down investment stuff with anecdotes and stories that non-financial geeks can understand.
Hey, this is Michael.
And this is Chuck.
It's Thursday, June 15th, 2024, and this is the 15th episode of the Iron Capital Podcast.
Woohoo!
Woo! So let's get to it, Chuck. What's on your mind today?
Matthew McConaughey.
Oh, I was not expecting that.
You were not expecting Matthew McConaughey?
I was not.
Yes. He is on my mind because our industry has left people dazed and confused.
I was going to say, is this a dazed and confused? Which era?
Exactly. The very beginning.
The start.
Yeah, all the way back to the start.
Mm-hmm.
So, we've been talking about kind of really what I would say is financial planning stuff. We've been talking about living on a budget, and controlling the amount of debt that you have, setting up savings, and then getting started in your 401k plan for your investing future.
The beginnings of investing.
The beginning of investing. And frankly, that's where most of our industry just stops.
Yep.
They just stop, and then they just say, well, pick some funds in your plan, and and then leave it at that. And you wonder why people are confused about the actual act of investing.
What investing is.
Yep. And while all those steps are incredibly crucial, if you don't invest properly, then to a large degree it's for naught. So to me, this is the most important part.
Well, yeah. Well, then let's just get to it. I mean, let's talk. And I love the whole simplifying idea that we've been trying to stay in. So let's just let's start with the beginnings of how you invest and what is investing.
Sure. Well, the most important thing to understand, and if everyone who listens or watches us forgets everything else we say, hopefully they will remember this. There are only two ways to invest money. And the first is that you buy something. It can be anything. But you buy something with the intent that over the time that you own it, it's going to grow in value. And at some point, you're going to sell it to someone else, hopefully at a higher price.
Yeah.
All right. Now, we refer to that as equity because this is something that you own. And the most common example, of course, is stock, and we'll talk about that. But that is the first way to invest.
Yep.
You buy something that you believe is going to increase in value over time. The second way to invest money is that you loan your money to someone else who promises to pay it back plus interest. All right, and there, there's all kinds of examples of different loans from mortgages to car loans to bonds, but all of those are just loans, and you're loaning your money to someone else, and you're hoping that they will pay it back plus interest, and that's how you're going to make money in the future. And those are the two most important things. And it sounds so incredibly simple, and it is actually so incredibly simple, but strangely enough, it is the most sophisticated of investors that tend to forget that.
Yeah.
And they tend to make the big mistakes.
Yeah, I love the idea of getting back to first principles, because whenever you're trying to understand something that you think is complicated, the way to do it is to start from the very beginning and say,
absolutely.
What are you doing here? Well, what is the stock market? When people make the comment, I'm invested in the stock market, what does that mean? What do they mean? And talk a bit about that.
So, so we'll start with what is stock?
What is stock?
All right. Yeah. So again, the first way you invest, equity investing, is you own something. Now, it could be anything. It could be a piece of art. It could be real estate. That could be gold. I mean, there's all kinds of things that you could invest in. But the point is that you own it.
Yep.
And that you believe that it will increase in value over time. The number one way of doing that, and it's because it's really the best investment, is to invest in companies. because companies, unlike things like gold, are actually dynamic. They can grow. The company itself can grow. Its earnings can grow. It also has an intrinsic value, all right, because you can calculate, okay, this is how much money this company makes. So that money that this company makes is worth something, and you can estimate what that value is. And those are very important. And so that's why so many people invest in companies. And stock is simply ownership in a company. So we always use the example, because we're here in Atlanta, of Coca-Cola. If you own stock in Coca-Cola, you own a piece of Coca-Cola. And in the long run, if Coca-Cola is doing well and continues to be the number one beverage company in the world, you're going to do well and you're going to make money. If Coca-Cola suffers, then you're going to suffer, because you're the owner. You actually own the instrument. Okay.
Yeah.
So that's what a stock is. The stock market, and this is one of the things that I think so many people, again, they fail to understand the most basic things. The stock market is simply that. It's a market. It is a store where you go to buy stocks. When people say that they're invested in the stock market, really there's no such thing. I mean, unless you own shares of the New York Stock Exchange. You're not invested in the stock market. You're going to the stock market to buy stocks, which are simply ownership in companies. That's all it is. But it's a store like no other store in the world. And of course, we know, our viewers can't tell, but across the street from us is one of the largest malls in Atlanta. Mm-hmm. And in any one of those stores over there, when they mark their prices down, the crowds grow and more people want to go in and want to buy. Yeah. The stock market, unlike all those normal stores, every time they put their products on sale, people want to run away. Yep. And every time that they mark them up really high, people want to come in. But in the reality, we should do the opposite. Yep. Because what we're doing, again, is investing in companies, because we want to buy them when they're cheap, because we want to own them for a long time and then sell them when they were expensive. Yeah. Which is the opposite of what most people do.
That's true. Well, I also like distinguishing ownership of a company and of a stock from something like a commodity, because when you're buying a piece of a company or stock, you're buying human ingenuity in a lot of ways. The ability of the person, of humans, and very intelligent humans, to solve problems. And do things in a positive way. And I mean, that's really the difference. I mean, a lot of people are like, well, hey, why don't you buy gold or something else that you can purchase? It's just a rock.
Yes.
Someone may buy that rock at a higher price, you don't know, but it is a rock at the end of the day. It's the same rock at the end of the day 10 years from now and 100 years from now.
Correct.
Whereas that company is dynamic and changes because of the people that make it up.
Right. And so, like we said, going right back to the beginning, when you're investing in equity, any form of equity, you're buying something that you own because you believe at some point in the future someone is going to be willing to pay more for it. Okay, now it doesn't have to be a stock. It can be gold, could even be art, something like that. But the thing is, a bar of gold is a bar of gold. I mean, if you get a bar of gold and you bury it in your backyard and then 30 years later dig it up, it's still just the same bar of gold. And you're just hoping that someone is going to want to pay more for it, which historically has not been the case. I mean, gold is at all-time highs right now. It is barely above where it was in 1980. For almost 40 years, the price of gold went absolutely nowhere because, again, all it is gold. Yeah. But a company, again, is dynamic. To your point, I mean, they can create new products. You take Apple, for an example. When I was a kid, and when Matthew McConaughey was going, all right, then Apple was a computer company. Yeah. They sold, their primary product was the Macintosh computer. And their big advantage was that it was easier to use than a Microsoft computer. And so that's what Apple was. Today, Apple's all about the phone. I mean, it's completely changed because of the innovation that is involved, and then their business has completely changed. They're completely different, and they're massively larger than they were, a decade ago. And so, companies are dynamic, and that's why they make for the best investments, because they can actually grow. Now, there is a flip side of that. Companies can also shrink, and they can also go out of business, and that's why there's a risk there. And I think it's important to understand risk.
No, risk is extremely important. Well, do you want to speak a little bit more about bonds before we move on? Obviously, we talked a little bit about equity. Bonds is a little bit less sexy, but an extremely important part of the investment landscape.
Right. So, again, the second way you invest is you loan your money to someone else who is going to pay you back plus interest. All right. And the most common way we do that in the investing world is through bonds. And bonds are loans to governmental entities and to corporations. If a big corporation or the government needs to borrow money, they issue bonds. And when they issue that bond, it's just like any other loan. They're promising to pay the money back plus interest. And as a bond investor, you don't have the same upside potential you do in investing in a company that could grow exponentially, but you have a promised payment and a promised interest rate that we refer to as yield, which will help your investment grow over time, assuming whoever you loan your money to will actually be able to pay it back and give you your money back plus the interest that you were promised.
Yeah, and that's why it's called fixed income, because as an investor, you know that if someone pays the promised amount, you know exactly where you're getting that amount is fixed.
That amount is fixed, and you're getting those payments generally twice a year.
On a regular basis.
On a regular basis, and that is income.
And so again, any investment you can possibly make is some derivative of those two things.
Absolutely.
It's owning something, it's getting, it's lending someone money, it's a combination of those things. There is nothing else, that's all there is.
Correct. That's it. There is no other thing. And so the things you should always ask yourself as an investor when you go into any type of investment, and no matter how complicated the salespeople want to make it sound, you ask yourself, what am I doing here? Am I buying something that I own? If so, why do I believe it's going to increase in value over time? Or am I loaning my money to someone else? And if so, who are they? Can they pay me back? Am I going to get my money back plus the interest I'm promised? And again, it's the most sophisticated of investors that forget to ask those questions.
It's also the most sophisticated investors that always blow up.
It is. You're absolutely right.
We'll talk about that. Let's first talk one thing that's a really hot topic is alternative investments, quote unquote, that everyone wants to talk about. Again, there's no alternative, but still, explain that a little bit if you would.
Yeah. The alternative investments are basically, it's a marketing term. It's not real. There is no alternative. There's only two ways to invest money. And if you buy something that you own, that's equity. But people will say, oh, it's alternative because it's not your standard stock or bond, which are the two most popular investments that people make. It's usually not sold through the stock exchange or the bond market as those other types of investments are. There's almost always some form of illiquidity, which means you just can't get your money back.
You can't sell it if you need
quickly.
To immediately.
The easiest one for people to understand is real estate. Real estate is often thought of as an alternative investment. And obviously, if you own real estate, you can't just get your money at a flip of a switch. If you need your money back, you're going to have to sell, whether it's a house or an office building or whatever kind of real estate it is. You're going to have to sell it in order to get your money. The building that you own is not liquid.
Yep.
And so that's why they refer to it as alternative. But the truth is, there's nothing alternative.
Yeah, the simplicity of investing in public
Right.
markets,
Yeah,
which
yeah.
are what we're talking about, generally
Right.
not alternatives, is you can sell a stock immediately and get your money tomorrow. And if you have a bond, you can sell a bond immediately. Same thing with funds that own those types of investments. Again,
Right.
if you own an alternative, oftentimes you could have to wait days, months, years to sell that when you need your money. And sometimes
Right.
you get paid additional compensation for having that ability not to be able to sell it.
Oh, sure.
Sometimes you don't.
Yes.
But it's not the same thing, and as far as the liquidity, and that's a big thing people need to understand. But it's still not magic. There's this view that if you're in alternatives, then you have this magical return stream, right?
Probably the biggest alternative today is what's referred to as private equity. So
Yep.
these are investing in companies that are not publicly traded.
Yep.
And the sales pitch, which quite frankly is a complete lie, is that these are somehow less risky than investing in stocks of public company. The truth of the matter is that owning a company is owning a company, whether it's publicly traded or privately traded. Your long-term risks are just the same. The problem is, and this is something our industry has done, is that we have defined risk as volatility. And so we define risk as an industry, which I don't think, quite frankly, is the right way to define risk, but we define risk as the price movement on a daily basis. And when you have a publicly traded stock, you know exactly what that price movement is every single day. You
Every single
see
second.
it. Every,
you could if you want to.
From
9 to 4.
9:30, yeah, from 9:30 in the morning until 4:00 in the afternoon, New York time. You can see exactly what's happening to that stock you own. And just last week we had a scary day.
Mm-hmm.
And if you want to pay attention to that one day, you all of a sudden you see these price movements move dramatically. Now in private equity, because it's illiquid, you don't see that.
Yep.
Now, just because you don't see it doesn't mean it's not there.
Yeah, if you had tried to sell it in that exact
Right.
same moment, you would have realized
that it is just as risky,
just as volatile.
if not more risky. And and so unfortunately, that's just the way things are. Our industry loves that because they love saying, the claiming that it's less risky because you don't see the volatility, because you don't have anyone who's telling you what it's worth every second. And they can charge much more for it.
Yeah, well, that's it. I mean,
because-
the alternatives. I mean,
Yeah.
again, you can invest, at a fair price in
Right.
public markets, and
Yeah.
you're usually paying over 2% and maybe 20% of your profits for many alternatives. It's a very high.
Sure.
It's very expensive. It's great for Wall Street.
Yeah,
But it's not.
and that is, as we've said in the past, the only thing that's really alternative is what you're paying.
Yep. Yep.
But that's really again, I think the confusion on risk, and that when people invest, we believe that real risk is the odds of losing money
Yep.
over the long haul. And when we mean that, it's like if you're investing in a company, what are the odds that something really bad is actually going to happen to the company? Not that the stock price is going to fluctuate because of all kinds of things that aren't actually related to the real world. But what is going to happen over the long term with the actual company itself?
Yep.
And before the days when Wall Street said that volatility was risk, we used to believe in something called the margin of safety. And that was that you're calculating what you believe the company is actually worth from an intrinsic basis, based on the earnings of the company and the future potential of the company. You can estimate what you believe the company is worth, and the difference between that and the price that you pay. And if you pay a price that's significantly lower than that estimate of what you think the company is actually worth, then you have a margin of safety in your investments.
Yep.
And that to us is the best way to invest. And again, that's something that people forget about when they define risk in the wrong ways. This is what happened to bond investors in 2022. When they had the worst year ever in the bond market, and bonds are always said to be safer.
They're always the safest place to be.
Right, because again, it's a loan. You have a contractual obligation there. You also they tend to be less volatile than stocks in terms of daily price movements. But in 2020 and 2021, bonds were as expensive as they've probably ever been. And when you buy something, when it's really, really expensive, you have a huge amount of risk.
That is risk.
That is risk.
That's actual risk.
That is actual risk.
Yeah.
And that's exactly what happened in 2022.
Yeah.
And so, really, that's how I would sum this up. Is that the beginning of investing is remembering these fundamental things, that there's only two ways to invest. One is you own something that you think will increase in value over time, and we refer to that as equity. The most common equity is stocks. Or you loan your money to someone else who's going to pay you back plus interest.
Yep.
And that is fixed income. Most common example would be bonds.
Yep.
And those are how you invest. And then you judge risk by what are you paying for those versus what they are really worth in the long run.
Yep. It's like everything else. Keep it simple. To understand something, you've got to start from the beginning and you got to keep it simple.
Keep it simple.
All right. Well, thanks. We appreciate it as always. Let us know if you have any questions, anything else you'd like to hear about. We always we love the comments, and we'll see you soon.
Iron Capital Advisors is an independent registered investment advisory firm headquartered in Atlanta with clients nationwide. Learn more about us at ironcapitaladvisors.com. The Iron Capital podcast is produced by Iron Capital Advisors. Our awesome original theme music was written and performed by Michael Smith and Leah Calvert. This content is for educational purposes only and should not be relied upon for investment decisions or advice. Clients and employees of Iron Capital may maintain positions in the securities discussed. Please like and subscribe to the Iron Capital podcast on YouTube and wherever you listen to podcasts. Thanks for joining us. We'll be back with another episode soon.